EA says the update is as a result of continued Houthi attacks in the Red Sea, causing longer shipping routes. Let me bring in Viktor Katona, lead crude analyst at Kpler, to help us break down the latest news. Victor, thank you for being on the show. So the IEA mentioned nearly 1.9 billion barrels of oil were at sea at the end of last month because of those disruptions in the Red Sea, and they've caused more trade to go around the Cape of Good Hope. What impact has that had on fuel demand?
Well, I think, first of all, longer shipping routes mean that need more fuel, right? Pretty much Africa is the bonanza, the fuel bonanza in Africa is very much fueled. Sorry, forgive me the pun, by the fact that ships actually need more of diesel, more of that marine fuel to go around. So it definitely did produce an additional, an incremental effect on global oil demand. But I think we should not forget the much bigger story. Rather than just usual shipping consumption, I think the global economy is in a much better shape than many people assumed for 2024. And I think that is the key story that sometimes it might go, a little bit under the radar whenever the IEA publishes this. But I think the main reason why the IEA actually increased the demand figures is that 2024 no longer feels as depressive as it felt, let's say, a year ago, when many people expected, the interest rates to weigh in and the global economy kind of persevering through all the difficulties that it has. I think right now we're at that breakout point where we actually can say that it's looking good.
And oil prices, last I checked, have extended gains. But even with the IEA's new forecast, there's still a big gap between its projection and the forecast OPEC has made. IEA lags OPEC by almost 1% of daily world demand. So what should traders and investors make about these mixed signals on oil market strength in 2024?
Well, I think the classical rule is that you take the IEA assumptions and the OPEC assumptions, and you take the middle way between the two, and that's where oil demand will be in 2024. I think that's a relatively safe assumption for this year. I think the IEA is gradually moving higher and higher. OPEC doesn't really change its assumption. It's an ultra bullish assumption. I mean, we give them that. That's their pet project, pretty much, projecting 2.3 million barrels per day of a growth. But I think if you look into the market right now, the market actually feels robust. The shipping disruptions have effectively kept oil price above 80. And we're moving into a summer period, which actually feels very strong on the physical market. So demand is picking up. And because of that, I mean, 85 is already the reality today. Oil prices have been breaching the $85 per barrel threshold. And beyond 85, 90 is the next breakout. And I think that's very probable that we will see some upwards movement towards the $90 per barrel mark very, very soon. Because again, we don't really have massive downsides. The economy is looking better than it used to do. The Red Sea disruptions are still in place. Everything is pointing towards a bullish sentiment.
Let's shift gear now to the impact of drone strikes on Russian refineries. So we're learning now that Russia's seaborne oil product exports fell 1.5% in February from the previous month. What else can we expect?
We definitely can expect lower Russian exports of oil products for a prolonged period. And I think one of the reasons why we have effectively moved the oil prices, the Brent prices have moved from 83 to 85, is the market realizes there's drone strikes. There's going to be less diesel in the markets than we expected. And the guys that relied on Russian diesel now need to buy it from somewhere else. And there's going to be more competition for the same barrels. So again, I think the drone strikes on Russian refineries is one of the key bullish topics of this week. And very much they have driven oil prices higher because people realized that if free refineries are getting bombed, and their atmospheric columns are on fire, it's a long-lasting impact. It's going to take at least 2-3 months to repair all of them. And in that period, exports are going to be very, very low.
All right, Viktor Katona, lead crude analyst from Kpler. It's been great speaking with you. Many thanks for your thoughts.